Hello guys, Steven Dexter. Welcome to this YouTube videos, and today we're going to go over some of the tickers that happened last week. And I know the market has been slowing down for the last 2 weeks, so in the next month we're probably going to head into a different season until probably the next stimulus check comes into the market, and after we have another 2 or 3 1000% gain, then the market will be back. Before that, let me go over all of the tickers that happened last week, and also in the next couple videos I'll be covering some of the techniques and concept I have discovered in the last, I would say, a year and a half. So it will be a good time to review all of the methods for you to trade consistently and being profitable in this market. So before I start this video, make sure to click the like button and subscribe. Let's get into the video. Alright, so for the last week, GME was the major play, and I will go over my entry and exit, and also my thought process as well, and what I learned from it, and also what should you trade it in the next time. So let's go over the yearly chart first. Historical chart, stock went from $20 to $500. There were tons of volume traded in between 350 to 500. I would say the majority of the back holders are between 300 or above. Now let's look at the detail in the $200 to $300 range. So between January 28th to February 1st, there is a decent consolidation. You can see that it's anywhere between 240 to 250. And that's the first consolidations you can see. The second one will be 350 area, but that's a little bit too high since the stock faded all the way to $50 a share. If the stock drops way too hard, you are normally using the first layer of resistance for you to risk off. So when I saw GME went from $50 to $150 in the after hour, I was preparing that, okay, where is my risk into the next day and how should I risk myself, because the price range right now is not very ideal to the $250 area. Before the market opened, I was looking at the pre-market action. There is a consolidation between 130 to 140. So it kind of sets a top twice in the after hour around the $200 area. So after market open, I chose to short around the 150 after showed a morning weakness and covered into the $100-ish. So whenever you are trading a $1 billion cap, normally that there is going to be a huge bounce right after a huge panic, because these type of billion-dollar companies do have some type of fundamentals, so they do not drop like penny stocks like 75% in one day. So I chose to cover half around 103, and I re-shorted into the bounce around 130. So I waited, and the second bounce actually took my risk around $150. Then I covered, took a partial loss, but the entire trade still is a profitable one. So looking into the next trade, so the stock did a fake breakout around 170, also testing the pre-market resistance as well. So this type of consolidations can be a shortable consolidation, but normally you want to use the major resistance for you to risk off. So the major resistance for you to risk off on the first layer will be 250. So the second potential entry can be around anywhere between 150 to 160, risking the consolidations. That's where I would short into. And going into the next day, as you know, that every single gappers, they do normally fade anywhere between 50% to 75%. So in this case, GME did fade around 60 to 65% of the entire gain and pushed into the next day into the consolidations and faded again. So the difference between a small cap and a big cap like GME, their chart actions and risk reward, they have a little difference. Small cap, they do fade anywhere between 60% to 75%, and bigger caps, if they tend to squeeze and heading into a huge resistance zone, they normally fade around 50%. So personally for GME, they are very overextended, and I was planning to cover when the stock fades about 50% of the entire gain, but the stock did perform that had more risk reward. So overall, I'm satisfied on this trade. There is one other trade I want to go over. The second ticker I want to talk about will be RIOT. I think I missed the entire risk reward when it dropped from $71 to $45 area. you can see that normally when the stock performs the first red day, there is a second red day, and normally they will fade anywhere between 50% to 60% of the entire gain. So if you are looking at the entire risk reward, the 50% mark is anywhere between $30 to $40 area. But the chart action did not perform what I expected. So let's go into the detail of each day, especially on that first red day. So on February 18th, this is the first time the stock went red and it pushed up to the pre-market resistance. So I was using that as my risk to short into. Overall, I covered into the panic pretty much with my full size. I left a little bit, wanted to add around 71. Normally, I do want to add into this type of overextended gap down. But if it's a $1 billion cap, the bounce normally bounce back to 75%, sometimes even more. So I'm unsure about how much you can bounce, and also my ability to read this type of $1 billion cap level 2s are sometimes not accurate. So my aim was around 71, but it bounced way too far. I was looking to short around into the next day again, but it faded by the end of the day, so I waited to see if it can actually perform the next red day. But it was testing the all-time high again, so I left it alone. Then the stock did the $70 consolidations and faded all the way back to 50. So something to learn from those two trades. When you are trading a $1 billion cap, their maximum drop-in percentage is anywhere between 20 to 26%. So they do not drop like 30%, 40% on a day like a normal penny stocks. And also they do bounce really hard. So make sure when you take a positions, you want to cover into the weaknesses and also aim for that 20% to 26% range to cover your short positions. And also, whenever you're shorting into a multi-day runners, have some type of patience, because multi-day runners do require about anywhere between 2 to 3 days of holding your short positions. All right, so one extra thing you guys can track. Ever since the stimulus check that came in each month, there is a huge wave of volume comes right after that. So after about mid-March, there's the next stimulus check coming in. So one thing you guys can track is you can track all of the volume between the first one and the second one to see how much buying power was left going into different stocks. So let's say that the first wave, I traded about RIOT, GME, and overall traded 30 tickers, and each ticker was trading $3 billion. So you can add them together to figure out what's the total buying power of each stimulus check. So you will know there's about 50 to 60 tickers you can play if each ticker is trading anywhere between 500 million to 1 billion per ticker. So overall, to figure out how much buying power on each stimulus check will help you to generate how many plays you have left, and also to predict how much dollar amount can be traded on each ticker. So in that way, you will be much more confident sizing into this huge volume, and also have a sense of if the market is slowing down or market is heating up again at the same time. All right, so that will be end of this video. Thank you very much for watching, and I'll see you guys in the next one.